What goes up must eventually slow down, and Canada's housing market, after years of skyrocketing prices and frenzied bidding wars, is finally entering a phase of cooling. For buyers who have long been waiting on the sidelines, the shift may feel like an overdue opportunity. For sellers, however, it raises tough questions about pricing, timing, and expectations. With sales volumes dipping, housing starts leveling off, and forecasts pointing to stagnating prices through 2026, the market is clearly signaling change. But is this the long-awaited correction, or just a pause before the next surge? Let's explore the latest data, expert predictions, and what this means for buyers and sellers across Canada. The current market picture. Canada's housing market has been through cycles of boom and moderation before, but the last decade has been unprecedented. Ultra-low interest rates, rising immigration, and limited supply fueled double-digit price growth in many cities. Now the pendulum is swinging back. According to RBC, home resales are expected to decline by roughly 3.5% in 2025, driven by soft demand. This slowdown reflects the lingering impact of high borrowing costs, affordability challenges, and buyer hesitation. Adding to this cooling effect, housing starts remained flat in the first half of 2025. Construct Connect reports a notable decline in condominium projects, particularly in major urban centers such as Toronto and Vancouver. Condos, once seen as a more affordable entry point for buyers, are facing headwinds as developers hesitate to launch new projects amid rising construction costs and shifting buyer preferences. Meanwhile, Reuters highlights that Canadian home prices could dip around 2% this year, with little momentum expected in 2026. In practical terms, this means homeowners looking to sell may not see the windfall profits enjoyed in previous years, while buyers may find more room for negotiation. Yet it's not all doom and gloom. RBC points out that confidence is gradually improving and a more active second half of the year is anticipated. As interest rates stabilize and some buyers re-enter the market, activity could pick up, though likely without the frenzy of years past. Why is the market cooling? Several factors are converging to temper the once red-hot Canadian housing market. Interest rates and affordability. Higher mortgage rates have priced many would-be buyers out of the market. Even with modest declines in home values, monthly payments remain challenging for households facing tight budgets. Supply and development. Slowdowns, with housing starts flat and condo projects declining. The pipeline of new homes is not keeping pace with population growth. However, slower development also means less upward pressure on prices in the near term. Shifting buyer psychology. After years of feeling pressure to buy now or be priced out forever, buyers are exercising patience. Many are waiting to see how much further prices could fall before making a move. Macroeconomic uncertainty. Broader economic trends, including job market stability, global trade challenges, and inflation, influence consumer confidence. Uncertainty often leads to hesitation in making large financial commitments like home purchases. Regional variations. Canada's housing market is far from uniform. What's happening in downtown Toronto may differ greatly from smaller cities in Alberta or Atlantic Canada. Toronto and Vancouver. These markets are experiencing the sharpest declines in condo construction. Affordability remains stretched, making buyers cautious. Calgary and Edmonton. These cities have seen stronger relative demand, with detached homes in particular maintaining appeal thanks to lower entry prices and a robust job market linked to energy. Halifax and Atlantic Canada. After experiencing rapid growth during the pandemic, these markets are cooling but remain attractive to out-of-province buyers seeking affordability and lifestyle advantages. Montreal. Moderate demand persists, but supply challenges and affordability are creating a balanced but slower market. This regional divergence underscores that while the national trend is cooling, local dynamics matter greatly. Opportunities for buyers, particularly first-time homeowners who have long felt locked out. The current market offers several advantages. Negotiating power. With fewer bidding wars and longer listing times, buyers can negotiate more favorable prices and conditions. Choice and patience. The rush of the pandemic years is over. buyers now have more time to view properties and make decisions. Potential incentives. Developers struggling to sell new units may offer incentives such as upgrades, covering closing costs, or flexible financing. Strategic timing. If confidence improves in the second half of the year, entering the market before momentum returns could be wise. Challenges for sellers, on the other hand, must adjust their strategies to align with a cooler market. Pricing. Realistically, overpricing a property could result in it sitting unsold for months. Competitive pricing is now essential. Staging and presentation. With buyers having more choice, well-staged and move-in-ready homes stand out. Flexibility in negotiations. Sellers may need to accommodate buyer requests for repairs, closing dates, or financial adjustments. Longer timelines. Homes may take longer to sell, requiring patience and realistic expectations. The bigger picture, a healthy correction. While a cooling market may feel unsettling, it can also be seen as a healthy correction. Canada's housing market had reached unsustainable levels of growth. Moderate price adjustments and slower sales could restore balance, making homeownership more attainable for future generations. At the same time, the structural challenges of limited supply and growing demand have not disappeared. Population growth, particularly through immigration, will continue to drive long-term housing needs. This means that while the current cooling phase may offer breathing room, housing affordability remains a long-term issue for policymakers to address. Looking ahead. As we move into the second half of 2025 and beyond, several scenarios could unfold. If interest rates stabilize or decline, buyer confidence may return, sparking renewed activity. If supply remains constrained, particularly in single-family homes, prices could stabilize or even edge upward again. If economic uncertainty deepens, the cooling trend could extend further, keeping prices flat or declining into 2026. In all cases, the market is unlikely to see the explosive growth of the past decade in the near term. Instead, a more measured, balanced pace is expected. The Canadian housing market is in transition, offering both opportunities and challenges. Buyers may find their long-awaited moment to enter the market, while sellers need to recalibrate strategies to succeed in this new reality. So, what do you think? Are we entering a long-term correction, or is this just a temporary pause before another surge? If you're a buyer, are you planning to jump in now, or will you wait and see if prices dip further? And if you're a seller, how are you adjusting your approach? Share your thoughts. I'd love to hear your perspective on where the Canadian housing market is headed next.